It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.
Hello everyone, welcome to INR Bonds weekly newsletter Search for Yields. I am Nikhil, and in today's topic we're going to talk about the Fed rate hike cycle and as well as how it impacts the bonds which are trading over and about 12%. That means the bonds which are high yield bonds. The last 2 years when the interest rates were all at all-time lows and investors preferred high yield bonds to beat inflation or to get healthy portfolio returns. However, given the last 6 months, the interest rate cycle changed and all the central banks across the world hiked rates. The bonds with the high yield bonds also, the yields of the high yield bonds also risen. The investors of these bonds are finding a tough time to sell the bonds without incurring the capital losses. And for the investors who are planning to invest right now in such bonds, this video will educate them why one should not look at high yield bonds given the interest rate cycle is changing and also there is an economic downturn. So before we jump into this topic, I would like to start with what is the quantitative tightening and what is quantitative easing. The quantitative tightening and the easing are the monetary policy tools used by the central banks in order to provide the market with the liquidity and also suck the liquidity when there is too much of money in the market and there is too much of inflation. Currently, the markets are seeing the quantitative tightening where the central banks across the globe are hiking the rates more aggressively than expected due to the decade highs of inflation growth. From the latest RBI and the Fed monetary policy decisions, where they not only hike the inflation forecast, but also they have reduced their GDP growth outlook. Fed has hiked the rates by 75 basis points, which is the steepest rate hike from 1994. In such kind of scenario where the central banks are hiking the rates and the bond yields are rising, the high yield bonds, especially which are below the investment grade, tend to have a sharp rise in yields. Given that there will be a given the investors will try to exit those bonds due to the weakening economic conditions, which will put additional pressure on their businesses. For example, a company which has a weak financials and has raised the money at 10% during the time of pandemic, it will find very tough to raise the same amount of money at 10% rate, given the yields have moved up and also the economic conditions weakened. The company has to come out with a much higher rates in order to refinance the maturing bond, and also in case if they want money to fund their capex plans or the working capital. So the investors who are planning to invest in this junk bonds or the high yield bonds must look at their financials and their growth outlook, whether the company or the corporate will pay back the coupon without defaulting. For that, we have a solution that is a QuickInvest by INR Bonds. We have a set of curated bonds where they run through various financial parameters and macroeconomic risk parameters, and we show a INR Bonds credit risk score, which shows that the risk worthiness of a credit issuer. So through this, an investor can easily understand what is the riskiness of the corporate and what is the yield they're getting that makes sense or not. So do download the QuickInvest by INR Bonds app and enjoy the smooth process of investing in corporate bonds. So coming back to the rate hike cycle, the markets currently are factoring another steep rate hike by RBI and the Fed, and the globally the markets are continue to fall and the yields tend to rise. And the dollar continue to strengthen, which shows that especially the emerging markets will have to fight with more inflationary pressures. Thank you for listening in. Do check out our search for yield videos on our YouTube channel. You can educate yourself on the personal finances of bonds. Thank you.